Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll take a look at will be the Australian US dollar. Aussie US dollar holding on to its gains despite some serious dollar strength, some serious euro weakness, I should say. Aussie's holding up pretty good. You did, however, shift these two shorter term patterns lower, your 5 and 10. So as a day trader, you'd be selling rallies in this market. As a swing trader, if you trade that 10, 25, and 50, maybe those higher time frames, then you're still buying dips. So you know what? I like a market where you're trading both sides. And to sum it up, that's it. You're, as a shorter term guy, you're selling rallies. A little bit longer term than that, you're buying dips. So you're on both sides of the market right now. And I like that because that means you get to trade more. Next market will be the dollar Swiss. Dollar Swiss, big week for the dollar Swiss. The last 2 days, you can see it really blasted off there. Look at that. All tradable patterns are higher. All those lower time frame patterns are higher, in line with the higher time frame patterns. So, you know, you're very close to a long-term breakout in this market. Look at that. Let's pan out to a much longer-term chart. I'm going to go with a monthly chart. And to me, this is potentially the trade of the decade. Well, I'll say it is the trade of the decade. You have to be long dollar Swiss here. Look at where that market's been. Look at potentially where it could go. You know, even a modest uptick from here based on that 15-year bear market, and you're going to go beyond par. We talked about 120 being a conservative number in the past, and it is, but yet that's a whole lot of money between here and 120. So potential massive trade in the making right there. So we like dollar Swiss on the upside for a couple different reasons. Back down to a daily chart, you can see how close we are to a breakout. So that's definitely one to watch for a big potential trade there. Very close to a breakout. Very excited about that trade. Next market, dollar index. Similar chart, albeit not as much upside potentially. The big difference here is the secondary pattern is still down in the dollar index. That's a long-term pattern. There it is. You see secondary resistance right there, 98, the figure there. So market hasn't clawed through that level yet. That's going to be a level to watch. Secondary support resistance, that's actually the time, that and the 50-day too. Anytime you have higher time frame support or resistance, that's the time to counter trend trade actually. So it's kind of funny, you had two massive days up in the dollar index, you shifted all those short-term patterns higher. Definitely from that perspective, from a shorter term trader's perspective, we're looking to buy dips. On the other hand, you're almost at long-term resistance, so that's the time you counter trend trade. So here's another market where I like it because potentially you could trade both sides. And for sure, for us, you know, we'd rather be trading than be on the sidelines. Next market, the euro US dollar. Big shift. You simultaneously shifted all those short-term patterns down there. Secondary pattern is still up though. Nearly a mirror image of the dollar index itself. The euro shifted everything down. That primary pattern is still down. However, that secondary pattern is still up. So conversely, you're coming up on longer term support there. That'd be the time to counter trend trade the other way. So you're not quite there yet. So short term selling rallies, the 10 and 25 shifting lower like that, those are big shifts, yet coming up on support pretty quick there. So another one where potentially we're on both sides of the market. Here's the gold market. Gold held up pretty good, similar to the Aussie there. You had that massive euro weakness. It really didn't translate into the gold. All you had was a 5-day shift down in the gold. Long term though, that secondary primary definitely down in the gold. From an investor standpoint, you'd still be on the short side. Shorter term trader, however, you're buying dips as a short-term trader. So let's watch this level here. If that 10-day pattern, I believe that's the 10-day pattern right there, 10-day support, 155 or so. Watch that level. Watch that level for a trade. If it doesn't bounce off it or starts getting progressive closes below it on those lower time frames, then you have to switch around and start selling rallies in line with that higher time frame secondary pattern. I don't mind that. Last market, U.S. interest rates. Really, this is the most influential of markets right now in the global economy. U.S. rates. We talked about this last week. That secondary pattern was holding up, and you know, yeah, it's something when you have all the short-term patterns down. Generally, you're selling rallies there until you get on top of long-term support, and that's what we had here. Anytime you get below 2%, you see how that market snaps back. So you have good support just above 1.9% in that market. You actually shifted to 5-day higher too. So another market where, again, you're on both sides, but longer term, you'd be favoring higher interest rates. Longer term, that's going to support a stronger U.S. dollar. So our strong dollar thesis that we've had our teeth into for a couple of years now has not changed. Long term, we're still dollar bulls. That's what the patterns in the markets today are telling us. My name is Jay Norris. Thank you so much for attending, and we'll see you next week.